Welcome everyone, great to have you all here. Now, some of you will have joined me before, so you know who I am. Some of you are joining for the first time. I'm Chris Ashton, the head mentor at the Corellian Academy. Today's session is the third of 5 webinars I'll be running across the rest of 2025, all focused on using technical analysis to help you trade CFDs on the Plus500 platform. If you would like to see the previous 2 webinars in this series, there is a link to the Plus500 YouTube channel on the Zoom chat for you right now. By using that link, you can see all of our previous webinars, not just on technical analysis, but specific markets like oil, gold, US stock indices, as well as risk management, position sizing, and using stop losses. Before I move forward, just a few housekeeping points. The webinar will last approximately 20 minutes. There will be a Q&A session at the end of the presentation. And Richard Adcock, the Corellian Technical Analysis Mentor, is with me today. So feel free to add your questions to the Zoom chat or the Q&A that you have access to. And please note that trading CFDs involves risk, and this session is for educational purposes only. It is not financial advice. Great, let's move on. So today our title is Technical Analysis Techniques. Should I follow the crowd or not? In other words, using technical analysis to help us identify when we should or shouldn't be trading within a trending market. Now, why are we covering this topic today? Well, it's often easy to get caught up in the euphoria of a market move, especially if a CFD you're monitoring is accelerating in a particular direction. A situation that can tempt you to buy or sell purely because the crowd are doing so. These types of scenarios can reflect unreliable and unsustainable price action that, if followed without a plan, can lead to losses and an erosion of confidence and frustration. Over the next 20 minutes, I'll discuss crowd psychology and emotional trading, look at how to assess the sustainability of a trend, including outlining 2 technical indicators that can support traders of all levels of experience to establish a reliable trading strategy and judge if a price move or a trend is valid. And then I'll finish by running through a case study of silver's rally in 2025 and show you how these indicators could have supported your trading. Right, let's get started. So for the next few minutes, I want to run through the psychological aspects we may face as traders when trying to assess whether a price move for a particular CFD is valid and sustainable. Now, every trader can be susceptible to the pull of the crowd, and it can be argued that crowd behavior is a double-edged sword. On the positive side, it can fuel strong trends in the price of a particular CFD, and this can provide potential trading opportunities where a trader takes advantage of a more sustained price move in the direction of the trend. However, the downside is that it might lead to herd behavior, which can create overreactions in the price of a particular CFD. And this can see traders fall into that herd mentality trap. And this is where the fear of missing out on a particular move can lead to trading on emotion. And this can lead to impulsive trade entries into trades that you may regret. It can distort your analysis and force you into poor risk-reward setups where the amount you may end up losing on a trade far outweighs your upside profit potential. As an example of this type of move, let's look at the daily chart of oil during 2025 and the highs that were posted on January the 14th and June the 22nd. Both sessions initially saw sharp accelerations to the top side, posting new price highs for that phase of the trend. But each came after what had already been a sustained period of upside price strength. Of course, this is all with the benefit of hindsight, but each peak proved to be a false move higher and one which was rejected, leading to a price reversal followed by a prolonged period of weakness materializing. In January, the correction developed over a period of weeks. However, the drop in late June happened in a matter of hours. In this situation, would we have been drawn into buying with the crowd? If we were sucked in, would we have had the risk management skills or stop losses in place to get out quickly and preserve our trading capital? These are tough situations to deal with for any trader. So let's now look at the emotional side of trading and discuss how we might overcome this temptation to become involved in executing a trade in a CFD that has already seen a significant move. Number one, being disciplined can assist you to keep your edge, and utilizing technical and technical indicators can help to keep you grounded. Number two, you can learn how to spot more consistently if a trend is liable to continue or if a move could be exposed to a potential reversal. Number three, it is important to realize it's human nature to have doubts before entering a trade. But by using technical analysis, it can help you to be ready to assess whether the current price is the correct level to act on. Number four, make sure to have it clear in your mind that you are entering a trade because your strategy has produced a valid opportunity, not just because you want to be involved in an ongoing directional move. Number five, when uncertain, remain vigilant. Keep your discipline and plan your next move before jumping in. After all, it is the uncertainty, the what if, that can drive impulsive trade entries. It can push traders to chase moves late and often at poor risk reward levels. Due to this uncertainty, your reliable market analysis can become distorted, and this can lead to traders ignoring or overriding trusted setups and signals they have used in the past successfully. It may even reveal an emotional bias. Recognizing this uncertainty can keep traders self-aware and possibly help to avoid reactive decisions, which can often be the wrong time to enter a trade. So how do we spot this type of price activity in our day-to-day trading? Well, there are three questions that's worthwhile considering asking yourself before pressing the button to execute a trade. And these can help with your decision making. Question one, why am I executing this trade? Consider whether you have carried out your usual analysis of the fundamentals and or price activity, and above all, be honest with yourself. Question two, ask yourself, does it align with your trading plan? A trading plan is something to fall back on when under pressure. It helps to maintain discipline when times get tough, and this may include whether you are following strong, trusted technical signals that have been used successfully in the past to execute a trade. And question three, ask yourself, am I reacting to crowd momentum? Consider whether you are only executing a trade entry because everyone seems to be doing the same. What could possibly go wrong in this situation? This may be a good time to sit on your hands, accept that you have missed a move, and start working on finding your next high probability setup. Take a screenshot of these questions and consider using them as a checklist before every trade. Briefly pausing and running through these questions might allow you time to process the real reasons driving your trade entry and hopefully help to keep any emotions that you may have in check that may impair your judgment. Right, now you may have heard the term trading strategy before, and I've referred it, well, as trading strategy and a trading plan earlier in this webinar. However, you might be uncertain what this means. A trading strategy simply means a plan or series of techniques you use to establish your trading decisions. It can include what you know and trust, like fundamental reasoning, or technical approaches such as price patterns and indicators you feel give you reliable signals on which to base your trades. Your trading strategy is personal to you and one that you will develop over time. However, by highlighting the various technical indicators within these webinars, we hope to showcase options available on the Plus500 platform that you might wish to include in your own trading strategy. So with that in mind, what indicators will I be covering today? Well, they are trending-based indicators that can be used to support the decision-making required to overcome some of the issues I've just discussed. And these are moving averages and the ADX indicator. These tools can help you assess whether a move is sustainable or overextended. Let's break each one down. So if I start with moving averages first, These are a relatively basic but popular tool within technical analysis, and they help traders smooth out price data, identify trends, and hopefully help to make more informed decisions. There are two primary types available to use on the Plus500 system. These are simple moving averages and exponential moving averages. Both serve as distinct purpose in assessing market behavior, and both can be used to assess any time period that you choose, and they can be used independently or they can be combined. The simple moving average calculates the average closing price of a CFD over a specific period. For example, a 20-day average adds the last 20 closing prices and divides by 20. It offers a steady but lagging view of price trends. The exponential moving average gives more weight to recent prices, making it more responsive to current market movements. This sensitivity makes it a particularly useful tool for short-term trading signals. Two of the most popular signals derived from moving averages are called the golden cross and the dead cross. A golden cross occurs when a short-term moving average, such as the 10-day, crosses above a longer-term moving average, such as the 20-day, but only when both averages are rising. This is typically seen as a positive signal, indicating that an uptrend may be developing. And this can be seen on the daily chart of gold that is on screen for you now. If I add a 10 and 20-day moving average to the chart, you can see a bullish signal for gold emerges when the shorter 10-day average crosses above the longer-term 20-day average at the end of August, and prices move higher after this period following that cross. Now, a dead cross, or a death cross as it's also known, happens when a short-term moving average crosses below a longer-term moving average, but only when both are falling. This provides a bearish signal which may offer confirmation of a downtrend or a deeper correction in price. If we use this daily dollar-yen chart as an example and add those same 10 and 20-day moving averages, you can see this occurring in January and again in April, suggesting the start of a more bearish period for dollar-yen prices. One nuance in these examples is where a cross between a short-term average and a long-term average is seen, but they are moving in opposite directions. This situation occurring is classed as providing a neutral signal and can often suggest a sideways range in price. I have highlighted this as an example for you on screen now, using the daily chart of gold during the sideways range that occurred earlier in the year between late May and August. Watching for these type of crossover events can add confidence to any directional bias when confirmed by things that we've covered in other webinars like volume or general broader market context. Other uses for moving averages can be as dynamic support or resistance levels, depending on the direction in which the average is moving. For example, in an uptrend, prices may pull back to the moving average before resuming their price higher again, making the average a useful indicator as a support zone. And this can be seen on the daily gold chart on screen right now, where the 10-day moving average provided support when prices dropped on September the 16th and 17th. In a downtrend, the moving average can act as a resistance level, providing a cap on rallies, as can be seen on the daily chart of Aussie dollar during early December last year. In these situations, moving averages can be useful for highlighting areas for trade entry in the direction of the ongoing trend. By this, I mean wait and buy a dip to an average which is moving higher, or wait and sell a rally to an average which is moving lower. Moving averages can also help pinpoint potential levels for stop loss placement, but in a dynamic way. If, for example, as traders we are long of a particular CFD and the market is rising, we could place our stop loss under a 20-period moving average, as breaks below this might be an indication of a more extended phase of weakness. The advantage of using a moving average to highlight a stop loss level is that as prices move higher within the uptrend, so does the moving average, meaning your stop loss also moves higher and trails below the price action, increasing your profit potential as prices rise. Obviously, the opposite is true for price moves within a downtrend, where using a stop loss above a falling moving average can help you to maximize that profit potential. Now, a 10, a 20, a 50, and a 200 period moving average are commonly used benchmarks, with the 200 period moving average often viewed as a long-term trend filter. However, you can experiment with different periods and find out what works well for you. I've highlighted the key takeaways on screen for you now, so feel free to take a screenshot. In conclusion, moving averages are versatile. They smooth out noise, they highlight trend direction, and help you manage entries and exits. When combined with other indicators and price action analysis, they can significantly enhance confidence in trade decisions. Now, let's look at the ADX indicator and how it can help us gauge trend strength and consolidation activity. Now, the average directional index, or ADX for short, is a popular trend strength indicator that helps traders assess whether a market is trending or consolidating, regardless of direction. Unlike some technical indicators that signal overbought or oversold conditions, the ADX indicator focuses purely on the intensity of the trend. So what is this indicator? Well, the ADX is derived from two directional movement indicators. The first is called the positive directional indicator, which measures upward price movement, and the second is called the negative directional indicator, which measures downward price movement. The ADX line is a smooth average of the difference between the positive directional indicator and the negative directional indicator, typically calculated over 14 periods, which is the default setting on the Plus500 platform. If we just focus on this ADX line first, it is important to note that it does not indicate price direction, only the strength of the prevailing trend. A rise in ADX line suggests strength behind the current trend, whether it's in an uptrend or a downtrend, while a fall in ADX line suggests the current trend is slowing. How can we use the ADX, and what does it show within a CFD's price? Well, we can use these ADX levels to highlight the strength of the current trend. As an example, let's attach the ADX indicator to a daily euro-dollar chart for 2025, so you can see how this developed across the year. An ADX reading above 25 indicates a strong trend, no matter if it's a bullish or bearish trend. An ADX reading below 20 suggests a weak trend. If the ADX reading moves above 40, it reflects potential for higher conviction moves. In this type of setup, it can suggest the current trend may continue further. We can also use the level and direction of the ADX line to give an indication of the strength of the current trend. A rise in ADX line can help confirm that the momentum of the current trend is strengthening, while a falling ADX line signals a weakening trend or potential for a move to a more range-bound condition. The ADX can also be used for spotting consolidations within trends. When the ADX falls below this 2025 level, it suggests there is a lack of directional price conviction. Within this setup, the price of the CFD may be entering a sideways range, moving to a period of consolidation activity. And it is at this point that as traders, we may want to assess whether we want to be involved with this non-trending market. Now, if we move one step forward and add the positive directional indicator and the negative directional indicator lines alongside the ADX line, this can be useful for identifying more prolonged trend phases. As an example, let's add these lines to the daily euro-dollar chart for 2025. In an uptrend, a rise in ADX line with a positive directional indicator line above the negative directional indicator line confirms increasing positive strength for a move. While in a downtrend, a rise in ADX line with the negative directional indicator line above the positive directional indicator line confirms a more bearish momentum is evident behind a particular move. When these types of setups are evident, it can help traders stay positioned within strong trends and help to avoid premature exits during volatile conditions. It could also offer another reference to check if you're concerned about the timing of a trade within an existing or even mature trend. In conclusion, and I've put the main takeaways for the ADX indicator on screen for you again now, this indicator is a tool for evaluating trend strength, helping traders distinguish between trending and consolidating markets. Whether in bullish or bearish conditions, the ADX indicator helps to add clarity to trend assessment and can be used to complement other moving average-based tools. By using the ADX line alongside the positive directional indicator line and the negative directional indicator line, traders can gain insight into momentum, which can assist with timing trade entry, risk management, and strategy alignment. Now, it's always good to look at these technical indicators in practice. And so to end today's webinar, I want to look at a recent case study of silver. Just for consistency, I'm using a daily chart, but these indicators can be used over any time frame. On this chart, I've included a 10 and 20-day moving average and the ADX line together with the positive and negative directional indicator lines. The impressive up move in silver may have seen many traders question if the advance could continue, having seen such a strong move already. Looking at the chart on screen, we can see that the two types of indicators I have covered today both appeared to support the price strength. For instance, a 10-day moving average had been rising above the 20-day moving average since August 21st, 2025. On September the 16th and 17th, it was even the 10-day moving average that acted as a support level to the short-term setback and helped prompt fresh strength to print further new multi-year highs. Looking at the ADX indicator, the positive directional indicator line crossed above the negative line on August the 21st and remained above it, highlighting positive trending conditions. Then on September the 9th, the ADX line crossed above a reading of 25 to point to an uptrend. On September the 24th, the ADX line moved above 40 to suggest a more significant uptrend, and that continued into October. So looking at the silver chart for this period, the case can be made that the price strength seen since August through September into October was supported by positive signals from both indicators. Now, this is just a brief illustration for you to visualize how these technical indicators can be used in practice, and you may want to consider using them on the live Plus500 demo system to gain more experience in how they could assist your trading. Right, that concludes the presentation part of the webinar. I can see there's several questions already, so let's look at them with Richard.